Welcome to Accounting in the Wild, where we'll discuss various subjects in the tax and accounting world, also featuring tales from the field and interviews on various tax and accounting subjects. All this and much, much more on Accounting in the Wild. And now, here's your host, Jason Dinesen.
Hello and welcome to another episode of Accounting in the Wild. My name is Jason Dinesen. As always, Accounting in the Wild is brought to you by MyCPE1. To get continuing education credits for watching or listening to this podcast, head over to mycpe1.com. That's my-cpe.com. Important to remember the hyphen. And you can get continuing ed credit for this podcast. And you can find literally 15,000 hours of content for pretty much whatever professional license or designation you have at my-cpe.com. So welcome to the show. Today we're going to talk about the draft of a new W-9. We'll talk about Form 1099-K again, and also a little bit about what's called the tax benefit rule, which is something that will likely be making a comeback and will affect average people on their tax returns specific to state tax refunds being taxable on the federal tax return. It's been a while since we've done one of these podcasts, so welcome back. Let's start by talking about the W-9. So there's a draft of the W-9 that has been released. That's the first thing I'd say is it's not official, so don't use it. But you know, anytime the IRS is working on forms, they'll put them out in the draft forms section of their website. It's not a secret. So you could go out and look at it. You can look at the Form 1040 for this upcoming tax season and its draft status. All kinds of forms are out there. So on September 17th, the IRS put a proposed new version of the W-9 in the draft forms. And this would change in a big way how sole proprietors report their taxpayer identification number on the W-9. So currently, an individual can give an EIN instead of a social security number on the W-9 as long as the EIN is in their name personally. And there's a lot of confusion around this, in particular with LLCs. LLCs with one owner are taxed as sole proprietors if that one owner is a human. It's a little more complicated than that. I don't know if complicated is the right word. It's different if that one owner is not a human, if it's like a corporation that owns the LLC. But that's a different discussion for a different time. If it's a human and it's one human who owns that LLC, the default tax treatment in that situation is sole proprietor, with everything involving that LLC being taxed to the individual. And the term is disregarded entity, which you interpret literally. You disregard the existence of the LLC. And so what happens is, the instructions to the W-9 currently lay it out clearly, but people don't read the instructions oftentimes. And so what happens is LLCs will oftentimes, these disregarded entities will oftentimes use the EIN of the LLC, which is actually inappropriate. The W-9 should be filled out in the name of the owner of the LLC and the taxpayer ID number of that person, usually their social security number. Really, they should only be putting an EIN on the form if that EIN is in the owner's name personally. So the instructions have always said this in several places. People argue with me about that. I've been teaching on this subject since 2012. And this is how it's always been. People will argue with me about that. But I always say, I'm not making it up. I'm not trying to be edgy or something by taking some kind of controversial stance here. It's plain as day in the W-9 instructions. Currently, the current instructions are quite clear that LLCs that are disregarded entity sole proprietorships should put the name of that owner, the human, on line 1 of the W-9, and the taxpayer ID number should be the taxpayer ID number of that person, not the EIN of the LLC. But if you've dealt with W-9s before, you probably know that that's not how things get done in the wild a lot of times. So what the IRS is proposing to do is force a change by saying if you are an individual sole proprietor, including a disregarded entity taxed as a sole proprietor, you cannot put an EIN on the form, even if it's in your name personally. You have to give your social security number. This is just a proposal, though. It's a draft that the IRS put out in mid-September, and we don't know when or if they'll actually release this form for real. There is a date printed on it in the upper left corner. It says January of 2026. To be clear, though, that does not necessarily mean that in January there's going to be a new W-9 that suddenly appears. The last revision to the W-9 was in March of 2024. And if memory serves me, I believe it had said October of 2023 on it when it was in its draft status, and it was in draft status for many, many, many months before it was finally released. And sometimes these draft forms are never released. But this is just some information to know, because this would be a significant change in how sole proprietors, including disregarded entity LLCs, report things. Someone asked also, how will I know when a new W-9 has been released? That's tricky, because back in March of 2024, when the IRS released the version of the W-9 that we're using now, they said nothing about it. I mean, we had known that there was this draft floating around, and like I said, it was out there for many months in the draft forms. But when they released it for real, they said nothing. So the W-9 is popular. It's one of the most popular forms on the IRS website. So when you hover over forms, the W-9 is right underneath the Form 1040. It's that popular. And when you click on that, it actually takes you to a sub page devoted just to the W-9. And there's a section on that sub page that says, or the heading says, recent updates. And it has always said, for as long as I can remember, no recent updates. It said that even in March and April of 2024. No recent updates. The IRS, I never saw anything about this in any news release. They have a somewhat active news page on their website. Nothing. They never put it in the weekly newsletter that they put out to small businesses. Nothing. I only knew that they released it because I teach on 1099s all the time. And so once or twice a week, I would go out there. I knew this draft was floating around, so I'd go to the W-9 site and just click on the form. And I remember it was a Thursday in late March. I just found it. It's like, oh, hey, they've released it. So, what I tell people is on this subject of a new W-9 or this draft of a W-9, wondering if it'll be released for real, just bookmark the W-9 page on the IRS website and go out there every now and then. Yeah, not every day. I don't even know if you need to do it weekly. I do it weekly because I teach all the time on 1099s, but for most folks, once a month or even once a quarter would be sufficient, I think. But just see, oh, hey, there's a new version of the W-9. What I just talked about at the beginning about this draft where sole proprietors would not be able to use social security numbers, that's a draft. It's out in the draft forms on the IRS website, but that is not the official W-9 yet, as of the date that this is airing in the middle of October of 2025. So keep using the version of the W-9 that says March 2024 on it. I had a few other things. 1099K is something that I wanted to talk about again. I wrote a series of blog posts on my Substack about this. Yeah, and I'm not going to belabor everything about 1099K. I mainly want to come back to one point, which is the big, beautiful bill changing the reporting thresholds back to what they were, and how that's going to result in fewer 1099Ks being issued. I had made a comment on a previous podcast about how, contractors, their eyes would light up about that because it would be easier for them to hide income. And someone pointed out that while that may be true, it's not always contractors who would be caught up in a reduced 1099K threshold. And so we'll talk about that in just a minute. But first, just what is 1099K, just to revisit that very quickly. So 1099K is issued by two parties. You have what are called merchant processors. So this would be the processor on credit card and debit card transactions. If you own a business and your business accepts credit cards, you probably have a merchant processor in the background handling that transaction. They will send you a 1099K at the end of the year showing all the money that you took in from credit card and debit card transactions. And those processors have always had to issue a 1099K for any dollar amount. There has not been a dollar amount threshold tied to them, and the big, beautiful bill didn't change that. What the controversy and the proposed change, and then the big, beautiful bill wiping out the proposed change, what that has to do is with another part of the 1099K law that says if it's a third-party network transaction, the third-party network or third-party settlement organization, TPSO, those are places like Venmo and PayPal, they have to issue a 1099K. Now you can read my blog post. It's part one. We talk about what a third-party TPSO really is. How do you know? Not going to get into that here, but it's PayPal, Venmo, places that hold the money in the middle. Basically, that's how I like to describe it. That's simplified. But it's places that facilitate transactions and hold the money in the middle. So reporting on 1099K started under the Affordable Care Act. That's a trivia thing, right? A little trivia tidbit. If you're ever playing Trivial Pursuit, maybe you'll win big. by knowing that 1099K started in the ACA. And for third-party settlement organizations, the threshold was set at, for business transactions, these places would only send a 1099K if the recipient had both more than 200 transactions processed and received more than $20,000. And then you had the American Rescue Plan, the third stimulus bill during the pandemic, which changed the threshold for TPSOs to $600 with no transaction count. This would have resulted in a massive amount of new 1099Ks being issued. We'll talk about that in just a second. And so the IRS kept kicking the can back on implementing the $600 threshold. And now the big, beautiful bill has said, we're not doing the $600 threshold. We're rolling things back to 200 transactions and $20,000 processed, effective this year. And so with that setup, I wanted to address again the discussion from several podcasts ago, and it's been several months actually since I've done a podcast. Took a little time off in August and September from podcasting, but I gave an example of a contractor with 10 business clients paying $25,000 each to him, and they all pay him through Venmo or PayPal. He receives $250,000, but Venmo or PayPal won't send him a 1099K because he didn't have more than 200 transactions processed. And the regulations say that the businesses that made those contract labor payments to the contractor, they don't need to issue a 1099 NEC because the payment could be subject to 1099K. So therefore, no reporting form would be issued. And so I talked about how that was what the American Rescue Plan was trying to fix, basically by dropping the threshold to $600. And someone pointed out that that part with contractors is true, but there's more to it than that. And I actually agree with that. Let's analyze this. So one is contractors and other gig workers. Avalara, which does a lot of 1099 work and also sales tax work, did a threshold. They did a survey of gig workers. This was before the big, beautiful bill rolled everything back to the way it was. They did a survey of gig workers about the lower 1099K thresholds. There's a link to the survey in part 3 of my blog post. But 19% of respondents said that they were considering changing their earning strategy. 20% were considering quitting one or more of their jobs. 20% said they would just switch to under-the-table work or some other method to avoid having to report the income. And so, one thing that could be said is, are we supposed to feel sorry for people who are making money and not reporting it? And I do want to be clear, I'm not saying hooray for the government and, the change to the threshold, hooray. That's not what I'm saying. I do think if you're going to criticize the proposed change to $600, which got rolled back in the big, beautiful bill, at least give legitimate criticisms of the $600 threshold. There's actually 2 criticisms and reasons why it's good that the big, beautiful bill undid that. So one is small-time operators. This is what someone pointed out to me after that podcast where I went on about people hiding their income. if you change the 1099K threshold to $600, certainly it would have brought more income out into the open. But it might have been an exercise in futility because the person who made this comment to me used Etsy as an example. Etsy is an issuer of 1099K. Say you have some small-time operator selling $1,000 worth of stuff on Etsy with a cost of goods sold of $900. A $600 threshold would force reporting of that, but this person only made $100 at the end of the day. So this would force the activity out in the open, but at what cost to the taxpayer and at what cost to the IRS of trying to enforce all of this, which brings us to legitimate criticism number 2, the increase in the number of 1099Ks. So in 2023, under the 200 transaction and 20,000 thresholds, the IRS took in approximately 12.2 million 1099Ks. The IRS estimated that a change to the threshold, changing it to 600, would have almost tripled the number of 1099Ks issued to approximately 33 million forms. So, with all these extra forms, it would have probably forced more reporting, more income out into the open. But what would the IRS have gained on this? If we use that example of the person selling stuff on Etsy for $1,000 with $900 cost of goods sold, $100 profit, if they're in the 22% tax bracket, that's $22 of tax owed. If they're in the 12% tax bracket, it would be $12. Versus what would be the processing cost to the IRS of all these tens of millions of extra forms. It probably would have been an exercise in futility. So a rollback in the thresholds to the original 200 transactions and $20,000, overall, that's probably actually a good thing. And then we're actually almost out of time in this episode, but just one more thing real quick. The tax benefit rule, what is that? That's something that comes into play a lot with state income tax refunds. And is that refund taxable on the federal return? And so with the higher standard deductions that we've had under TCJA, plus at the time a $10,000 SALT limit, state and local tax deduction limit, we haven't had to deal with the tax benefit rule as much on state tax refunds because more people were claiming the standard deduction. And if you claim the standard deduction, your state tax refund isn't taxable. And even if you itemized, if the SALT limit came into play on your itemized deductions, your refund probably wasn't taxable. So the big beautiful bill has made this higher standard deduction amounts permanent, but also greatly increased the SALT limit to $40,000 in 2025. With that increase in the SALT limit, you're going to have more people itemizing. You're going to have more people not hitting the $40,000 SALT cap, which means that if they get refunds from the state on their tax return, those refunds that under TCJA probably weren't taxable on the federal return are going to start being taxable again. So just something to be aware of. There's a blog post that I published on September 17th that goes into more detail on this with even some examples and extracts from spreadsheets, which I'm sure makes everybody really excited, but it lays it all out on different scenarios where the tax benefit rule could come into play again. So I think we should wrap things up for this episode of Accounting in the Wild, brought to you by MyCPE1. Remember, if you are a tax pro and you want CPE or CE hours for listening to or watching this episode, go to my-cpe.com and continue your professional learning journey. Until next time, I'm Jason Dinesen for Accounting in the Wild.
Thanks for listening, and join us next time for another edition of Accounting in the Wild with Jason Dinesen.